Hello guys and welcome back to the MD Investor, the channel where we learn about personal finance and how to get out of the rat race, educating ourselves and our children so we can break the cycle of generational poverty. If it's your first time, welcome. If it's your first time, welcome back, I should say. And if it's your first time, welcome. Consider subscribing and passing the information along, hitting the notification bell when new videos come out. You'll be notified. Okay, let's get into it. Continuing with the tax topic that we've been talking about. Last week we talked about how to discuss taxes and how we should think about taxes, and realizing that the tax system is basically incentives given by the government. Today we're going to talk about tax deductions for the landlord, or real estate tax deductions. So tax deductions for the landlord. We said 14, I believe, but I may give you a couple of extra. Okay, let's get into it. Tax deductions for the landlord. So we're gonna go through quickly. We don't want to make this too long. First tax deduction you'll get of the landlord is startup costs, right? So when you are considering becoming a real estate investor, you look at many properties before you eventually find a property that you like, right? So the government realized there's an expense in that. You got to drive to the property. You may need to seek the services of an attorney, right? You may need to get a LLC formation. And all of the expenses are deductible, okay? So the government said you can deduct up to $5,000 within the first year. Anything above that has to be divided equally over 180 months, which is 15 years. Okay? So that's it. Startup costs are deductible. Second thing that are deductible, repairs. Anybody knows if you have real estate, whether you live in a house, apartment, whatever, things break, right? The doorknob comes off, there's a hole in the wall, the roof starts to leak, the bathroom gets clogged up. There's a repair that has to be done. Again, as a real estate investor, the government really don't want you to incur, and any cost that you incur, they basically want to deduct it, because essentially you're doing this to improve the property, you're doing this to improve the neighborhood, and it shouldn't be a cost to you. So it's going to be deductible. So repairs. They distinguish repairs from improvement. Repairs, they can be deducted all within the same year that you incur the expense. And repairs are basically you're bringing the property back to its original state. Improvement, they consider you're basically prolonging the life or the useful life of the property. Example would be you have a leak in your roof, right? You know, you repair it. So they come and they put a couple of shingles in and no more leaking. That's a repair. All deductible within the same year. You go now and you get an entirely new roof, right? You know, you pay $25,000, you get a nice roof. That's considered an improvement, and that will have to be deducted over a much longer time. I'm not getting into the specific details and so on, because there's something called accelerated depreciation, which, you know, is not really necessary at this point. Okay, so startup costs, we know about repairs, improvements, they are deductible. Maintenance, right? So snow removal, landscaping, those are ongoing costs that are required to maintain the property. So, you know, you pay the guy X amount of dollars every time it snows, and the landscaper every 2 weeks, all deductible. You may have the same costs at your own private personal residence, but they're not tax deductible, right? You see, because you're not getting any incentive from the government to maintain your property. Yeah, it looks nice to keep your property value up, but that's fine, but you're not really doing anything for the broader economy. Rental property now, the same thing. It is tax deductible. You want to paint your house, your own personal house that you live in? Fine. It's not tax deductible. You want to paint your rental property? That's tax deductible. Tax deductible. Number 4, and this is a big one. It could be its own separate topic. It's called depreciation. Essentially, the government realized that things break down. There's wear and tear, normal wear and tear. We know that. Nothing lasts forever. The government said that your property, for the wear and tear that your property sustains yearly, they're going to give you a deduction. Okay, it's called a depreciation. Even though your property may be actually appreciating in value, maybe going up, they're going to give you a deduction. Okay, they say for a residential property that someone lives in, they say it depreciates over 27.5 years. So its useful life is 27.5 years. Okay? So we'll give you an example to make this real to you. Imagine you have a property that's worth $350,000. The land portion is worth $75,000. Right? $75,000 for the land. Land cannot be depreciable, or land does not depreciate, because land does not wear down. Land does not lose its normal value. It's land, right? So the land is $75,000. Total value of the property is $350,000. So the structure, the building itself, the building components, $275,000. So the building can be depreciated over 27.5 years. So you take $275,000, which is the cost of the building and structure, divided by 27.5 years, which is how long the IRS said a residential building can be depreciated. $275,000 divided by 27.5 is $10,000. The government will now give you a $10,000 deduction against your rental income. This is powerful. Even though your house, your rental property may be going up in value. Okay? Very, very powerful strategy. Just to add to your knowledge, commercial property, they say you can depreciate that over 39 years, right? So you buy a storage facility or a commercial building, you depreciate that over 39 years, okay? So let's move on. Number 5, real estate taxes. You know you have real estate taxes for your own personal home. You also have real estate taxes with your investment property, right? So it's 100% deductible, okay? 100% deductible. If you did not have this rental property, you would have no real estate taxes. So the government doesn't want it to cost you. So real estate taxes, 100% undeductible. Let me add this. Tom Realwright, who's the CPA for Robert Kiyosaki, Rich Dad, Poor Dad author, said, if you're paying any taxes and you're a real estate investor, you're doing something wrong. And that gets back to, I remember when Trump was having the debate with Hillary Clinton, and she said, you don't ever pay any taxes. He says, yeah, that's because I'm smart. Now you begin to realize that, you're not breaking the law. If you invest in the right assets, the government actually incentivizes you, and they want you not to be taxed to death because you're doing something good for the economy, okay? Remember from last week, there are 2 tax systems, one for the informed and one for the uninformed. Both are legal. Let's keep going. Number 6, let's say utilities. Number 6, utilities. So the light, the electricity, water. In some places, maybe even garbage removal, septic, sewer, all that stuff, deductible as a real estate investor. So that's number 6. Number 7, cleaning, right? A tenant moves in, a tenant moves out, and you gotta go in and clean the carpet, clean everything to make sure it's nice and ready for the next tenant. So cleaning services, again, deductible. Number 8. Number 8 would be interest. So you know that when you pay the mortgage, your interest, you pay interest on the mortgage. The interest that you pay, you get that form every year, the form 1098. You get it for your own personal home. and you also get it for your rental property. The interest that you pay will be deductible against your rental income. And the other interest you may pay, for example, you have a business credit card and you use your business credit card to pay the snow removal guy, or you use your business credit card to buy lumber from Home Depot, and you pay the minimum payment. The interest that you pay on a credit card will be deductible against your rental income. Okay. Number 9, car and travel expenses. Say you have to go to your rental property, right? You have to meet potential tenants. You have to meet your property manager. Maybe you have to meet a contractor. You're going to do some work on a property. The expenses you incur on that travel, because it's related to your rental property, will be deductible. I think the IRS said they charge you about, they pay you about 57 cents per mile. So imagine you're driving 10,000 miles per year, going back and forth to your rental property, checking on things. 57 cents times 10,000 would be about $5,700. Deductible against your rental income. Car and travel expenses. Long distance travel expenses. You may have a rental property out of state, right? You may live in one state and you may have to drive to another state to check in your rental property, maybe 3 times a year, maybe 4 times a year, to meet with the property manager, to see a piece of work that needs to be done, or to check on a piece of work that was done. Maybe you had to go to a new hot water heater or whatever. That long distance travel expense will be deductible against your rental income. Involving a long distance expense may be gas if you're driving, or correction, yeah, gas. It could be gas if you're driving. All right, if it could be mileage if you're doing a mileage deduction. And the reason why I say that is there's 2 ways to take the car deductions, the motor vehicle deductions. One, you can do a straight mileage deduction, so like 57 cents per business mile. All right. So, you travel 10,000 miles for the year, 57 cents times 10,000 would be $5,700 deduction. Or you can do the actual expense, right? Say, you have a vehicle that you use specifically for business, or even, yeah. So the actual expense would be whatever expense is incurred by that vehicle that you use for business. So the inspection, the car wash, the registration, if you need new tires, whatever expenses. So there's 2 ways to do that. Again, for business, it'll be deductible. Number 11, cost of hiring workers. So if you've ever lived in a building, you know that sometimes there's a superintendent who kind of takes care of what's going on in the property, right? So if your hot water not working, you go see the super and he'll kind of go check it out. Maybe he'll have to get he try to do the work himself, or if he can, he'll get contractors come and do it. That superintendent is an employee of the landlord. Whatever he paid that landlord in terms of salary or benefit is deductible against his rental income. Number 12, professional services. So you may have a property manager, right? Because you don't want to be getting a call at 2 a.m. about hot water heater and whatnot, and you have to pay the property manager. So that is deductible. You may have an accountant. You may have an attorney that you use because you have to evict a tenant for not paying the rent, and it costs a certain amount of money to pay the attorney. Your CPA may help you with your taxes. So all those expenses are deductible. Number 13, advertising, right? The tenant moved out and you have to replace the tenant, so you may have to advertise, whether it's in a newspaper, whether it's online, and that expense is deductible against your income. Number 14, insurance, right? You have a property, you need insurance, right? The bank or the lender requires it. So your premium for your insurance will be deductible against your rental income. Number 15, casualty loss. So for example, certain places are prone to natural disasters, right? Whether it's a tornado, whether it's in a flood zone, Or maybe just vandalism, right? Somebody comes and they, you got evicted, like the person we were talking about, and they say, I'm going to destroy this property before I leave. So the insurance company would repay you for the loss that you incurred because you're covered. That's deductible against your rental income. And let's add number 16. Give you a bonus. Educational expenses. And what I'm saying is that the IRS said, let me back up a little. All these deductions, you're getting them because the IRS said anything that is ordinary and necessary in your business is deductible. So that's the key word, ordinary and necessary. Ordinary means this is not unusual. People in this business incur this type of expenses, right? So, for example, if you are a physician working for yourself, small business, it's ordinary for you to have to pay for to maintain your state medical license. It's not unusual. All doctors have to maintain right? And it is necessary because they have to be licensed in the state to practice medicine, right? So in the real estate business of the landlord, these are ordinary and necessary expenses. So education, number 16. The government said that this education, such as courses or books or magazines, they improve or maintain your ability to become a better landlord. It is deductible, right? So you may be subscribing to a magazine to learn about how to become a better landlord, or how to more efficiently run your rental property business, or about taxes, or you may combine the education deduction and the long distance travel, right? And that's why most of these companies that are involved in real estate education, they always have these conferences. If you notice, it's always in nice places. It's always in Hawaii, 2-day, 3-day conference on how to improve your efficiency, how to become a better landlord, how to do so and so. And the reason why is because they know that it is tax deductible. So you're traveling to Hawaii for business to attend a real estate conference that's going to improve your ability to become a better landlord. So the airfare, the hotel, the rental car, and 50% of the meals will be deductible, okay? So just another video, guys, to let you know, none of these things we mentioned are illegal. They're all legal. The government wants you to earn an income. The government wants you to improve these properties. The government wants you to improve these neighborhoods. And because you're doing, and they're incentivizing you to do it. And because you're doing it, you're going to be rewarded with lower taxes. So another video, guys, is to increase our financial IQ so we can break the cycle of generational poverty, one video at a time. And I will see you on the next one. Don't forget, if this has benefited you, send a video to somebody you know, and hit the subscription button and the notification bell so you'll be notified when we post. See you next time.